Lydia?
Yes.
I have a slight concern that this might end up working little because I can see a delay in the slides.
Let me stop sharing my screen here.
Yeah, let's save that.
Shall I?
Let me try this. Let me try to switch it off and on and again, and we'll try again.
Sure.
If not, I'll share my screen.
Okay.
Are you doing this with OSB?
Yes.
Nicely done.
Okay, let's say that. Yeah, now there's no problem.
Those are fine. I think we're probably almost ready to begin. So once Philippe has introduced you, I'll pin you like we discussed. Okay.
Okay, I think we can get going. So hello, well, good morning, or well, mostly morning or afternoon. So today we'll have the same format as the other days with a keynote speech, a small break, 2 plenary sessions, and then we will split into the breakout rooms. For the first presentation, we are grateful to have Matteo Maggiori, who woke up very early this morning. He's live from the West Coast. So we are very happy that well, you accepted to do this and so early for you. And you will talk about the Global Capital Allocation Project. You have 30 minutes, and then we'll have 15 minutes for discussion. So
perfect. Well, thank you for having me here. I'm going to get straight into it, given that we only have 30 minutes. The basic question of capital allocation, I think all of you know what it tries to get at, is a fundamental question in most of macro and international macro, is who gets the capital, who provides it, which are the risks that are shared, which new risks might be created by sharing capital. Benefits are pretty obvious. There's a transfer from savers to productive users. We share risks, we diversify. It might be one of the forces that equilibrate things like exchange rates, interest rates, or the cost of capital. There's also a whole list of problems in economics that are connected to these capital allocations. Capital flights, crises, endogenous amplification of risks. Much more recently, the literature has also focused on unequal access to capital. The idea that particularly global markets are in a level playing field. Some firms, some financial institutions are very dominant, and that these markets can be gamed, or the international margin can be used to evade things like taxes or regulation, particularly from multinationals. What the actual project is, it's a realization that over the last 15 years, we've had very large crises where capital move fast, and there have been also very large policy interventions where the governments intervene in markets with FX interventions, with QE, and it became much more obvious to our profession that who owns which asset is an important question also at the macro level, not just at the micro level. So our project is really a research effort to shed light on how capital moves around the world and try to design better policies to confront these episodes. Today, I'll review some research results. I'll talk about the importance of currency in shaping capital allocation. I'll talk about the importance of international currencies, things like the dollar, and both in the cross-section and over time. And I'll talk a little bit about our most recent work on tax havens and offshore financial centers. The project has a website, take a look at it. But most of all, I'd like to stress that while I'm here giving the keynote, and it's very nice for Philippe to invite me, this really is a group effort. And my co-author get as much credit as me. Brent Neiman and Jesse Schrager have been long-term co-authors in this. We have a wonderful set of younger people that are both co-authoring and helping us. These large research projects really aren't a one-man shop. They're really a big effort of everybody together. So let me start with the first fact. Home bias. These have been around for a long time, since Proterba and French work, and it's the idea that investors overweight domestic securities. What we did is we tried to use microdata to dig a little bit deeper, in particular on the bond side, on what exactly shapes these portfolios, which firms match with which investors, and we ended up emphasizing something called home currency bias, which I'll highlight a little bit more. How did we do it? So a lot of what we do is we use microdata on a relatively large scale on holdings. So in one of the first papers, we sort of put together this data set based on Morningstar data that essentially has ETFs positions and open-end mutual funds positions around the world. The way you want to think about this is you see the balance sheet of all PIMCO funds, all Fidelity and Vanguard funds around the world, security by security, irrespective of whether they invest domestically, abroad, in equity, in fixed income, in anything that they do. This is not going to cover things like banks. It's not going to cover things like insurance companies. In later papers, we've added some of that data, and I'll talk about it. What was pretty nice about this is that it's at the position level. So it's at what is called the QSIP, the identifier of a specific security. We ended up focusing on 10 developed markets that are the ones where the data was the highest quality. Think of it as all the large developed markets. So the US, the European Union, the UK, Norway, Canada, Switzerland, those kind of countries. And it's a relatively long panel. The US starts all the way in 1995. The rest of the world starts around 2003. Think of it as unbalanced, as in, some countries will show up later in the data than others. And a lot of the work over the years has been harmonizing this data so that you can merge it with security information, with firm level information. I'm not going to go through the detail, but there's certainly an element of building this kind of effort. Let me start with a very simple picture that we found surprising. So here for each investor country, so the way to think of Australia here is I'm looking at Australian funds and I'm asking when they invest in corporate bonds in their own country, what fraction of the investment is in the domestic currency, the Australian dollar. And you can see that the scale is here at the bottom, and it's probably unsurprising to you that almost all of these bars are reminding us of a pretty obvious fact so far, which is in most developed countries, domestic funds held all the assets in domestic currency. British funds hold all the British pounds and so on. What's more surprising is what shows up on the other side. So what are we asking in this data point? We're asking, when I look at the rest of the world funds, conditional on them buying corporate bonds in Australia, what fraction of those holdings are in the domestic currency? And that one is a little bit more tricky because you can see that all of a sudden the fraction is extremely small. In some countries, it's like a few percentage points. You might get to like 25 percentage point. But you can see that it's extremely, the left-hand side and the right-hand side are extremely different. Now here we're conditioning on investing in the same set of assets. This is not the typical thing that I might not want to invest in your country. Here we're conditioning on the investment. So that one started looking a little bit different from what our models would predict. In particular, there's a big exception, which is the United States. The United States look exactly like our models would predict. They're relatively symmetric. The vast majority of corporate bonds that the rest of the world buy in the United States are in dollars, very much like when the US domestic investors invest in bonds that are in dollars. So you can see that the United States at the bottom looks very different from other countries. And if you're familiar with the way most of our models would work, this is sort of much closer and much easier to interpret than the rest of the data. The US is exceptional in this dimension. The beauty of the microdata is that you don't have to stop. At this level, we wouldn't really know what's going on. We don't know whether it's, are they buying different firms? Are they buying bonds in different currencies of the same firms? Is this like big firms versus small firms, exporters versus importers? So one of the nice things is that you can go a little bit deeper. But before I do that, we also started asking, okay, if the foreigners don't buy the local currency corporate debt, what are they buying? What are the currencies are they holding? And here, the way to interpret this bar, for example, for Australia, is we're asking when Australian funds invest abroad in corporate bonds, excluding, and you will see why, what they invest in the United States, what are they buying? And the red bar is what they're buying in dollars. And the white hollow bar is what they're buying in their own currency, as in Australian dollars. So the reason why I excluded the US is that I wanted to focus on the dollar as an international currency. So these are dollar bonds that they're buying in countries other than the US. So that the fact that the dollar bars are so high across countries is not an artifact that everybody has big holdings in the US. It's dollars somewhere else in the world. So what seems to transpire is that the first thing that these countries try to do is they try to buy bonds in their own currency. So when, for example, EMU investors go abroad, they try to get hold of bonds in euros. This is this hollow bar over here. The other thing that they do is that they try to buy bonds in dollars. which should remind you of the international use of the dollar. So, somehow investors in equilibrium are accepting it as a sort of currency that they like to hold. The complement here, what gets you to 100% is a little bit of the currencies of destination. So when the Europeans invest in the UK, they'll buy some pounds, and third-party currencies like the yen or the Swiss franc. So that's what it looks like. Now, how do we go deeper? We ended up in this paper using an identification at the firm level, which allows us to focus on currency. So let me explain what we do. On the left-hand side, we're asking, of the bonds that investor from country J buys from firm P, what fraction is held by investors for which the currency is domestic? That's this beta. So essentially what I'm asking is, country by country, as they go around the world, what is their disproportionate inclination to hold bonds that are in their domestic currency, in the currency of the investor rather than the issuer? Now, normally you have to worry a lot about the selection. And I will show you later that indeed issuers of international bonds and bonds in different currencies tend to be different from domestic issuers, the bigger firms and all that. So what we ended up doing is using firm fixed effects. So we're going to focus the variation of the paper on those firms that issue bonds in multiple currencies, keeping the issuer constant. That gets rid of things like, is the firm an exporter? Is the firm big? Is a firm that is particularly visible, so it's familiar to the investors, like Apple? All of that is going to end up in the fixed effects, and we're controlling for other things that we know about the bonds, like their maturity, their coupon, their credit ratings, things like that. Okay, so what we're interested is in this beta, and let me show you what these coefficients are and how to interpret them. So for example, this 0.89, so first let's do a prior. The prior should be 0. So if there was no bias, if I weren't any more likely to hold a bond in my currency than in bonds in any other currency, if I were holding something close to CAPM, that should be at 0. So the fact that they're close to large numbers like 0.89 means the following: that Canadian investors are likely to own 89% more of a bond that is in Canadian dollars compared to anything else. So that's what the home currency bias is. And you can see it here across countries. What you cannot do is you can't actually compare the magnitudes so easily across countries, because these countries have different wealth. And so the average fraction of a bond that they would hold varies a fair amount. But you can compare them certainly within country. There's a lot more in the paper. I'm just only going to summarize it here. But the reason why we like using the microdata to explain these more macro facts is precisely that you can start segmenting this in all sorts of possible ways to convince yourself that this is really driven by currency and not by some other attributes that currency will correlate with. So I think that's one of the nice advantages of these kind of setups. Of course, I'm now going to move away from that, and I'm going to start going to less identified, but also interesting patterns. One of the things that we were curious about is how this relates to a much more well-known fact, which is the idea that investors overinvest in securities issued by domestic firms. That's the home bias at the country level. That one you can do, although in a less identified way. Let me explain why. You can simply run the same exact regression, removing the fixed effects, but having dummies for country and currency separately. So a firm can only have one country, so you need to remove the fixed effect, but you can do this. And in fact, there was previous evidence. I think Frank Warnock had a paper looking at the US tick data, saying, look, there is this idea that when the US goes abroad, they buy a lot of dollars. And if you look country by country, this seems to be driving the decision much more than currency. And here we're going to formalize that a little bit more. So imagine that you do the following. You start by running the very simple regression of Potherben French is the other famous quoter of French. You're going to regress a dummy on country. Now, what do you find? You find very high coefficients. Again, if world CAPM was true, this should have been 0. Every country has a disproportionate tendency to own securities issued by its domestic firms, very high R squared. Here, the R squares are interpretable because we remove the fixed effects. In fact, here I also remove the controls. This slide has a sort of typo, precisely because I wanted to see how much of the variation of the panel comes from just this dummy. Now you can see why this effect is so famous. It absorbs a big part of the variation. It's a good description in terms of R squares of portfolios. Here's what happens if you do the regression with just the currency dummy. So you can think of this regression as a version of what I showed you already with the firm fixed effects, removing the firm fixed effects and the controls so that we can interpret a little bit more the R squares, but of course we're short on identification. You can see again, very high coefficients, extremely high R squares. So currency is a very good description of in equilibrium, how investors and firms associate with each other. It's not causality, it's not telling you anything that whether this is the firm or the investor who's causing this link in equilibrium. It's telling you that in equilibrium currency is an important piece of information if you want to know who owns the asset. If you pick a bond at random around the world and you want to know who's likely the owner, the currency is an interesting piece of information to have. If you put them together, what you find is that currency sort of completely swamps the home country effect. And I want to sort of make you understand that what you can conclude and what you cannot conclude. So the simplest way to think about this is imagine that you are a Eurozone investor and take the world bonds, excluding those issued by, take the world bonds and divide them in two categories. Bonds in euros, bonds not in euros. Within each of the two groups, there is relatively little home bias. Across the two groups, there's a huge difference in holdings. European investors tend to be very big in euros. Now, it is also true in equilibrium that European firms are the largest issuers of euros. So it's a sort of within and across group problem in a regression. When you're only conditioning on country, what you're picking up is a massive difference in the average level of investment between euro securities and non-euro securities by European investors. As soon as you control for currency, what country is picking up is the variation within those two groups, which is much smaller. So this is rocket science at some level. It's surprising that this wasn't known. I think why wasn't it not known? For those of you that are deep into international macro data, well, the currency of information of foreign investment, it wasn't so easy to get hold of. It's not like as a profession for many years, we had this information readily available and people didn't think of running this regression. It's only over the last 10 years or so that the international data has been improving exponentially and we get finer and finer splits of what exactly the investors are investing in. And this one turned out to be an interesting one for us. You can see that the same is true across all countries. What you cannot conclude that there is no home bias effect. You can also not conclude that currency is what drives quantitatively this. What you can conclude is that currency is an important equilibrium factor. Whatever model you're building and whatever the reason why the portfolios are the way they are, they better be related via currency in equilibrium. That's a strong description of the data. Okay, here we cannot make causal statements because we lost the identification. We're just summarizing the data. Okay, I showed you a little bit of the investor side. Now I want to show you something on the other side of the spectrum, the firms. If all firms were equally able to issue bonds in all currencies, there are no hedging costs, these might reflect investor preferences, but the ultimate capital allocation should be invariant to this. Why is that the idea? The idea is very simple in our models is currency, if I can hedge it separately, I will do whatever capital allocation I want to do in the real model. And then if the bonds turn out to be in the wrong currency, I'll hedge them perfectly and trade the currency separately. So currency shouldn't distort in a frictionless model the allocation. And I'll show you that in the data, it doesn't look like that. How do I do it? These are the Canadian firms. I ranked firms by how big are they in the domestic portfolio. So this dot tells me that the largest firm, the largest single holding in the Canadian portfolio accounts for 9% of all assets of the Canadian funds. So the monotonicity of the red dots is by construction, is how I built the x-axis. The blue diamonds are for the same exact firm, what fraction of the foreign portfolio in Canada does that firm account for? And you can see that the graph on the left looks like a jungle mess. A pattern appears when you take exactly the same ranking on the x-axis, but you drop Canadian firms that issue in foreign currency. You keep only those Canadian firms that issue in local currency. Now, a pattern appears with a big gap here. What is that wedge? It's telling you that there are Canadian firms that are quite big. There are large issuers in domestic currency. They account for a lot of the Canadian portfolio, but they get almost no investment from the foreigners. You can see that there is sort of like this big white space at the bottom of the graph. That's telling you that currency seems to be very strongly associated with who gets actual investment from foreign investors in bonds. We started worrying about, are these firms different? Is something going on? And there's a nice placebo test that you can do. So this graph on the left is the one I just showed you. We fixed the same firm and we looked at their equities. For those that have a publicly listed equity, you can say, is it true that the foreigners also stay away from the equity of those firms? And that doesn't happen. You can see that now there's no pattern between the red dots and the blue diamonds. So that's telling us there is not something about familiarity with the firm, how visible it is, how familiar are the foreign investors. It's something that has to do with the bonds of those firms. It's something that has to do with currency. It doesn't have to do with the firm itself, at least in terms of the investor appetite. If you do it across countries, that always shows up. So one of the surprising things was these are not emerging markets. These are some of the largest developed markets in the world for bonds. It shows up in the UK, it shows up in Canada, it shows up in Great Britain, in all of the countries. There's one big exception, of course, the United States. It's the one country where this doesn't happen. And this should remind you of the graph I gave you at the very beginning, showing you that foreign investors in the US are perfectly happy to hold dollar bonds. Once you realize that there isn't any skew in currency because of the role of the dollar, then it's no surprise that even those firms in the US that only issue in dollars roughly get the same proportion of capital from domestic investors and foreign investors, or those firms that try to issue in foreign currency. So it's a pretty different picture of the US compared to even other extremely large developed countries. This brings me to my two graphs on international currencies. Has this changed over time? Has this role of the dollar moved? And we found in the microdata a surprising pattern around the global financial crisis that I want to show to you. So what these two lines are doing is they're looking at cross-border corporate bond portfolios, and they're asking what fraction of the assets the country I owns in country J are in either euros or dollars. Now, the levels are what you would have expected before the crisis. The dollar and the euro are a big chunk of this, particularly the dollar. What we didn't expect is this time series pattern. Somewhere around the global financial crisis, there being a big switch away from euros and into dollars. And again, here I'm going to do it very, very briefly, but in the paper, there's a lot more about this. It's not driven by movements in the EU or the US. You can drop them. It's not driven by composition. It's really happening by currency. And you can also check that it's not mechanical, as in there are third-party currencies like pounds and yen that aren't moving. I'm only going to summarize the sort of cleaned up version. If you take care of all these compositional effects, the effects of the exchange rate and all that, you still find a pretty pronounced switch. This should jibe with what we've seen now with COVID, the idea that more and more the dollar is dominant in terms of world portfolios. And the financial crisis and the COVID crisis might have cemented this idea from investors that this is the ultimate safe asset. This is the very liquid currency. I'm not saying anything whether that's a good or a bad idea or a good or a bad belief, but it's the way it is. In the last few minutes, I'm going to talk about some of my more recent work. So on the importance of tax havens and offshore centers. So over the last few years, there's been an immense amount of interest in firms' usage of these offshore jurisdictions. And there's a lot of effort in the public sector, at the OECD, at the Fed, at the BIS. There have been sort of big efforts trying to understand what firms do in these jurisdictions. And here we're going to sort of try to help with that effort and do some research on securities. So I'm going to give you only the highlights and sort of do it rather briefly. But think about how the US and European investors invest in Petrobras bonds. So if you look at the data on residency, as in the data that ascribes all actions to the immediate actor, which is the most commonly used data in international, you find very little. You find almost no holdings. Now that can be right, and we know it not to be right because Petrobras is an extremely large issuer of bonds in international markets. So what's going on in the data is that Petrobras has a subsidiary in the Caymans. The subsidiary issues bonds. They're held by American and European investors. There's about $1 billion each. Also, Petrobras has a bunch of subsidiaries in the Netherlands, and those firms also issue bonds, and they're very heavily held by these investors. There's another $5 billion from the US investors and $6 billion from the Europeans. So you can see that whether you're taking a direct look at Petrobras as a parent company in Brazil, or you're looking at the Petrobras group worldwide, you're getting a very different picture of the exposure of large developed investors to this firm. This has been known for a while. It's something that we wanted to do systematically as a profession, and here's what we try to do about it. Let me skip these 2 slides because we're going to be short on time. We try to look at how our funds are holding assets all around the world and try to map them from subsidiaries to parents. Now, of course, we're well aware that we don't have the universal data. We don't have banks. We don't have insurance companies. There are other players that are not mutual funds and ETFs. In some cases, we could do better. For example, for the US, we added the insurance companies. For Norway, we could add the Norwegian Sovereign Wealth Fund. We hope to keep expanding these across countries. But also, I want to advertise there are excellent efforts in the public sector, at the IMF, at the Fed, at the BIS, doing also this with sort of registry data. So this is like a bigger effort than just what we're doing. But in our context, we can make use of a few useful assumptions. One that we did is the following. We assume that within each year, asset class and bilateral country pair, fund holdings are representative of the universal portfolio investment. What does that actually mean? It means that I don't have to have insurance companies and mutual funds look similar in many dimensions, equity versus debt, one country versus another. Any of that, I'm fine. I have to assume that within a particular narrow category, Germany corporate bonds 2017, they don't buy firms in very different proportions. And for some cases, this we could test. Let me just skip this there, because we're going to run out of time. Okay, here we go. So a typical example that we did was the US. So we do this for 10 economies, but here I'm going to focus on the US and Europe. A typical example that you could do is you could say, let me try to apply this to the TIC data. So the Treasury, for example, has been working on rephrasing their statistics in nationality in other terms. And here's how you could do it as an academic. You could sort of take the microdata, make some assumptions on representativeness, and I'm going to focus on unwinding only the positions of tax havens. And here's what happens. You can see that the Brazil, China, Russia, they're all countries where the direct holdings are much smaller. The main way in which American, British, European investors or the Norwegian investors hold assets in these countries is through jurisdictions in tax havens. So the example of Petrobras is pervasive. Now you can go much deeper than this. You can say, look, maybe I want to unwind all firms, irrespective of tax havens. Maybe I want to look at a different notion of what a multinational is. I want to reapportion them in proportion of their sales. We would love to do them also in proportion of other things like value added. We've not been able to so far. Part of what our project has done has been sort of develop this across countries and try to look for patterns. And here are 2 that I'm going to highlight before I sort of stop a few minutes late. Philippe, I'll apologize, and take questions. This isn't a US phenomenon. This is sort of like an across the board developed market investor phenomenon. This is the fraction that the US under residency invests in the BRICS. This is the fraction once you go for nationality. But you can see that a very similar thing is true for most other countries. It's just a way in which the investors match worldwide. Now, the nice thing about having it done with the microdata is that you can go pretty deep into the pattern networks. Where does capital start and where does it end up? And one of the things that we haven't done in our work yet is sort of try to characterize this network, even from a quantitative theoretical perspective. What it is that shapes it the way it is. Why are some firms using the Caymans? Why are some firms using the Netherlands? What have these countries done over time that has caused them to be like this? There's certainly big variation in this network. All of these were made available online for all the countries, the years, and the asset classes. It's an open question. I can tell you certainly episodes, anecdotes, some things that we identified, but we don't have a consistent story of why is the Netherlands sort of increased so much its activities in this dimension, what it is that makes it attractive to much international investors. Is it taxes, is it regulation? We don't know yet. I'm gonna do one last chart and then stop. The chart I wanna do is China, which is here. So one of the biggest patterns in the data is Chinese firms. Pretty much all Chinese firms that you know of, Alibaba, Tencent, and the like, they're all registered in the Cayman Islands. Now, this is well known. It's not like anybody has missed it, that Alibaba exists and is listed in New York. What we did a little bit more digging into is how this affects the idea of China as an extremely large creditor to the rest of the world. So the way to think about this is that China, very early on in the early 2000s, sold some companies on international markets, Tencent, Alibaba. These companies over time have become extraordinarily valuable, but they're using very sophisticated offshore structures that have essentially induced the valuation effects of these firms not to show up in the liabilities of China. Now, this has been really getting quite big. So, 10 years ago, this would not have been a problem. The difference between the official statistics and our estimates would have been tiny. But over time, as Alibaba becomes worth $500 billion, and so does Tencent, a pretty large gap opens up. What is the gap? The gap is the idea that the way in which China has adjusted its net foreign assets is by giving the rest of the world firms that have become extraordinarily valuable. So the liabilities have increased a lot, but we haven't quite registered these as academics or policymakers because of the way the accounting works through the Cayman Islands and through these complex structures. And I'm happy to go deeper into this in a few minutes in the questions. We really kind of missed this. So to me, the end point of where we are right now in these projects is, there's a bigger effort worldwide to understand these offshore centers. My hope is that, 4 or 5 years from now, this will be routine data that is provided by, the statistical agencies of each country, the international organizations. This was a bit of a pilot project where we tried to look at an academic level what could be done. The nice thing for academics is, particularly by using commercial data, you can get it. It's very replicable. Any of you can get the data, use the codes, and sort of figure out what you want to do with it or improve. The not so nice thing is you're going to struggle getting the complete universe at each point in time for each country. The other advantage is you can merge data across countries. Merging the 9 countries is no problem. A lot of the times when you have proprietary data, it's more difficult. That you can't merge so easily European and US data. There's lots of regulation. But these are all trade-offs. Here's what we did. I'm going to stop and I'm going to take some questions.
Okay, thanks, Matteo. So let's go for questions. Harold?
Yeah, really cool talk. I wonder whether you could give some sense of whether this is whether it can measure misallocation to some degree or not. So let me give a benchmark, which may be ridiculous, but it may be sort of helpful to get the discussion going. Suppose exchange rates are constant for just the sake of the argument, and suppose that all these bonds are risk-free. So then they're really all the same. And if the investors that want to buy bonds, there are firms that sell bonds, and there's a marketplace, but we don't particularly care who ends up holding which bond. Now, if you put an exchange rate risk in there, obviously, if you hold a bond that's denominated in dollar, that's different than holding a bond denominated in euro. But some of that exchange rate risk can also be hedged, right? So unless we see the hedging positions that these people take, we may still end up at the same allocation. So is there a sense here that people talk about the US being able to borrow more cheaply, or some notion of that sort that you could combine with this really beautiful analysis?
Perfect. That's a great question. So these graphs are as close as it gets, at least within our work, to answer your question. which is, you could have imagined a world that is, our typical theoretical benchmark in which currency doesn't matter because either it's too small of a risk or it can be hedged separately. If that was the case, you would normally struggle generating these graphs. Why? These graphs are telling you that there's a large wedge between big firms that the Europeans hold and firms that the foreigners don't seem to invest in. And we can pin it down to big currency because they're perfectly happy owning the equity of the same firms. They're perfectly happy owning similar firms conditional on having bonds in foreign currency. It's really the currency component that skews it. Now, what we couldn't do, because you cannot do it without a model, is make strong statements about, is this a lot of misallocation or a little misallocation? Is the typical problem of, say, all of trade, for example. This could be a model with very large benefits and extremely large fixed costs that generate these quantity outcomes, or it could be a model with extremely small benefits and extremely small fixed costs that also generates big variation in quantities. And so to do that, you need to impose much more structure. And a lot of the things that we've done in our work so far has been hesitant to do that because we wanted to stay as close as possible to just describing the data and telling you what it is that we can say and cannot say based on the data. But to me, this is sort of like, it's opening that door, but it's not quite going through the door yet. I think it's an interesting question. And as you know from the structural trade literature, there are ways to try to address that question that have to do with using the price data on the bonds, imposing a model and thinking carefully about, is it a fixed cost, a sunk cost, the distribution of the firms, and there's actually some recent work now going into that dimension. So I'm hopeful that this is going to serve as a springboard for that.
Hélène?
Thank you very much. Thanks, Matteo, for a very nice talk. I was wondering whether you have any information linking the currency bias of foreign investors to the horizon of their portfolio holdings, so their horizon of investment, or the idea would be that maybe, if you are a fund with doing some kind of carry trade, you have a very different view towards what you want to do in terms of foreign bonds compared to, a pension funds or let alone regulation. So do you have any information on that?
Yeah, so yes and no. So what we tried to exploit in the paper was heterogeneity among the funds in terms of things like size, very much actually from your work, bigger funds might be more professional, they have lower costs. We try to look at funds that specialize in holding foreign bonds versus not. And we try to look at an interesting effect, which is the bias due to, say, a big special corporate bond fund that is supposed to invest in the rest of the world, or is the bias due to the fact that large domestic funds of the US buy in proportion of their fund very little abroad, but of course in levels, because they're so big, they're going to account for a big fraction of the data. What we didn't, so we try to look at these dimensions, and the answer is it was pretty pervasive. It's certainly true that you have a specialist fund whose only job is to buy foreign currency assets. And of course, those are not going to show the bias, but those are going to be the small part of the data rather than the bigger part. What we didn't do, and I think, again, it's an open question, is start looking at the style of the fund. Is this a fund that likes to speculate in foreign currency? We try to look a little bit at hedging, and we really didn't do a great job. And now there's a recent paper that I received that does more of that. I mean, here, the national idea is they're already showing you that they want to get hold of assets in their own currency or dollars. So for the part that is in foreign currency, which very often is the sovereign, there is a national idea that they might be hedging that. Because if you're already skewing your portfolio to avoid foreign currency, chances are that on the part where you buy the foreign currency, you're hedging it. And for some big funds that have report the derivatives position, we could confirm that, but we couldn't do it for the universe, which is why I didn't make the paper. But then again, that's describing more the average behavior. There's certainly going to be the carry trade fund whose only job is to take the currency risk. And so I think what we haven't done yet in this project, and I would say a little bit even collectively as a profession, is find ex ante ways to think of the type of investor. And then look at the portfolios. There's work going in that direction. I suspect in a few years, there's going to be a hell of a lot more of that. And we're not there yet. We didn't go very deep. Other questions?
Maybe I have a question. We had an interesting paper the other day presented thing in the IMF section by Valentina Bruno, and they showed that when you have local and dollar bonds, these were government bonds, there was much more withdrawal in the local bonds, and they talk about the original sin. So I wonder whether in your data you can also find these type of features, whether the borrowing, so in corporate bonds, whether the borrowing in local currency may be more sensitive to shocks borrowing from foreigners, whether you could also find this type of result.
Yeah, I know the paper, and it's a very interesting paper. So there's a common pattern that we also see in our data. So first of all, no, we haven't gone there, but I find the results extremely plausible, at least based on what I've seen, both for the credibility of their own paper, but also because of what we've seen in our data, which is the following idea. The foreigners, particularly in emerging markets, tend to buy bonds offshore, and those tend to be in our currency. They tend to be dollars and euros. They tend to participate relatively little in the local market. That's not so true for sovereigns. For sovereigns, they're much more participant in the local market. And you might expect that in a big shock, there's essentially the following simple segmentation. If the bonds in foreign currency are always held by the foreigners are selling it among themselves. So the entire effect of trying to stay away from these bonds is going to go through prices. For the bonds in local currency, the foreigners can pull out, the domestic guys can step in, and there's a question of whether that's going to limit the price impact. It's an interesting question. I mean, I think of all this literature as pointing out there's a surprising degree of market segmentation, and this is going to have an impact on prices. And I think both now and finally in asset pricing and in international macro, I would say before asset pricing, there's always been an interest in the segmentation and the impact on prices. And this kind of quantity work is slowly building up to that. It's getting us more and more high quality data to sort of start asking those questions where you don't feel that you're asking a question that is infinitely more precise than the noise you have in the data. We're not there yet. I mean, to be clear, we're missing derivatives. We're missing, lots of other players that, we're not close to the universe as of yet. But we're way ahead of where we were before the financial crisis, say. And part of that is, I think with the crisis, everybody realized these are important pieces of information that we should have even for policy. So there's been a huge step up in the public collection of this data. At the same time, the private sector is very interested in this. So there's a lot of commercial data is becoming available. So I would say that the quality of the data is improving steadily. And I'm hopeful to see much more of that in the near future.
Refet?
So thank you very much for this. My question is going to follow right from the answer you just provided. And I don't necessarily expect an answer to this, but it's this. What is so special about exchange rate risk? There are all kinds of dimensions in which markets can be segmented, right? Why aren't they segmented by firm, by country, but by the currency of the issuance, not even by the issuer itself, right? It also feeds into this, right? So firms, of course, are able to issue debt in foreign currency, foreign to them, in the borrower's currency, which the borrower apparently wants, and the firms find it worthwhile to do so. If these were able to be costlessly hedged, it would make no difference whether I issued it and hedged or you bought it and hedged, right? So apparently hedging is expensive, meaning it's the residual claimant, the equity holders who are shouldering the burden of this. And of course, there is no way of issuing equity in foreign currency. But this would then speak to something like the equity premium puzzle too, that the equity has to return a lot more because it's returning in the wrong currency. So, but again, the only reason I am in all these countries, in all these firms, is I want to diversify, but I refuse to diversify in the dimension of the exchange rate. What is so special about that exchange rate risk?
Okay, so these are all excellent questions. I only have, partial answers because a lot of that requires model and much more data. But let me give you at least the partial answers, and then I'll tell you a little bit more about how I think about it, which isn't necessarily, strictly speaking, proved in the paper. So one thing that you mentioned is there's a big difference between currencies and equities. Sorry, bonds and equities. Bonds are nominal assets. They are a payoff in a currency. When you hedge them, you shouldn't think of them as deleting the risk. You should be thinking about it as transferring to somebody else. The bond is in dollars, and there's a mismatch with the investor. Now, the investor might decide that they don't want to hold the mismatch. They can pass it to another investor with a currency trade. But it's not offsetting it. An equity is a bit different. In equity, you need to start, equity is a real asset. It's an apple tree. And the currency of denomination matters for a different reason, which might be, there's cash in advance constraint, and to order by the equity, even if it's a South African company listed in the UK, I need to get hold of pounds. But there you need to start thinking a bit more about, is the equity fundamentally linked to the currency? As in, is the return of the real asset, does he have a covariance with the currency? For the bond, it's a little bit more straightforward because the return of the bond is a payment in a currency. It's not a payment to any real asset. It's a fundamentally nominal asset. Now, to your question about hedging, it's sort of interesting. The data, we couldn't, first of all, I want to be clear, in the paper, we couldn't do this. There is no systematic evidence on this. But the way that the bigger firms, for example, behave, it seems that most of the hedging is done on the firm side. So the firm knows that you don't want the bond in their currency. What they do is that they issue in your currency and then hedge. It's very commonly in large firms for the biggest currencies. Again, this is by inspection of a few hundred firms. It's not a systematic statement. But in corporate finance, there are good reasons why that would be the case. The firm is essentially, it's a long-term investor in the bond. It's short the bond until he repays it. So he hedges once with a swap and keeps it. An investor instead comes in and out of the asset. So it will have to also come in and out of the hedge all the time. So there are natural reasons why that might be the case. Now, I want to be clear, in our models, none of this should happen unless you put large hedging costs. This should be irrelevant. You can trade currency separately. It should never distort your real capital allocation. The paper, the point of some of our work was precisely to show you how far we are from that benchmark, that it is distorting it, and that we need to sort of figure out how big are these distortions and why is it happening. That's, I think, where we left it.
Okay, thanks, Matteo. I think we will close this session, at least formally. The next paper is in 10 minutes. So we will keep the discussion open, but in terms of the formal presentation. So again, thanks a lot, Matteo, for this presentation.
Output ratio grows, and at the same time, they go through structural change. That is to say that, like the bulk of the economy moves from agriculture to manufacturing and eventually to services. So in the last decade or so, there's been like a number of studies that have been trying to understand the drivers of structural change. Okay, and the key mechanisms that have been pointed out by these papers, namely differential productivity growth, a realistic modeling of the investment sector, non-homoscedicities in production, non-homoscedicities in preferences, kind of like preclude the existence of a balanced growth path generically, right? So there may be like some knife edge case conditions in which you get balanced growth, but in general, you cannot get balanced growth. Okay, so here, like the challenge that we are trying to address is to provide a generalization of the balanced growth path that allows us to characterize medium-term dynamics that kind of are general and are akin to a balanced growth, that kind of like basically map fundamentals of the economy, say like productivity and basically the model structure with the dynamic evolution of the economic system. Okay, and so this is where this concept of stable transformation path, or STRAP short, comes in. Okay, so this STRAP concept that we will introduce will basically focus on medium-term growth dynamics. Okay, so, and I want to kind of emphasize what it will not do first. So it's not going to be about short-run kind of like transitional dynamics in the neoclassical sense. So for like The models that I'll present will have those, and so, but we know that those are kind of very like shortly lived. So you can think about reveloking, for example, right? So that we're not going to capture. We don't want to capture these very, very, very long run dynamics. So what's going to happen to the economy, like say, like in 100 years and so on. Instead, we want to look like at the horizons, let's say like 10, 20, 30 years, and have like a good grasp of how, like the model, how these economies evolves, okay? And you know, at the end of the day, what we're going to have is kind of like a mapping with the between the fundamentals of the economy, and in particular the vector of productivities and how they evolve, and the path for capital and consumption and so on. And in so doing, you can think of this as generalizing the balanced growth, because you know, a balanced growth at the end of the day kind of like provides the same mapping. And so these medium-term dynamics, importantly, are going to be independent of initial conditions, right? And so the interpretation that you know, in the context of our application is that, you know, it's going to, like this strap is going to inform us about the generic development path that, you know, we should expect from a dynamic system, and kind of like help us disentangle what are these medium run dynamics from kind of like very short run, perhaps shocks and so on and so forth. Okay. And so the particular context that we have chosen to illustrate this is going to be, as I said, a model of growth and structural change. And the ingredients that are going to preclude balanced growth are going to be that we will allow for a non-unitary intertemporal elasticity of substitution, and we will have a realistic investment sector that is going to experience structural change itself. Okay, so with these features, it is well known in the literature that in general you cannot get balanced growth. Okay, and so we're gonna, you know, like we're gonna analyze what happens in this model along the balance, along the strap, to study the process of like you know, growth and structural transformation, and analyze what happens to a series of aggregate outcomes, what happens to a series of like sectoral outcomes. And in the quantification, we're going to argue that, you know, the strap enabled, like what the strap enables as a concept, it's going to, you know, allow us to think about like the generic properties of the models that are going to be quantitatively and qualitatively different from like these knife edge cases that people have looked at. So in the interest of time, I'll move on. But before doing that, I want to emphasize that even though, like, you know, as I said at the beginning, so there's like kind of like two parts to the paper. So there's this concept of strap, which by itself it's more general than the model that we're going to be presenting. And so, for example, other applications that we have thought of, that just as a means of an example. So there's like a number of models that think about the adoption of modern technologies, how economies transition from say traditional technologies to modern technologies, like the Hansen-Prescott's AER. Or you may think about the unified growth theory that one, you know, wants to think about the transition from Malthusian equilibrium to modern equilibrium, in which like this concept can kind of like, again, be very useful. In the context of investment-specific technical change, which it's well known that also relies on very knife edge conditions to have balanced growth. I think it can provide like a generic way to look at medium-term dynamics, and in particular, we've been working on, you know, applications thinking about the decline of the labor share. As so, for example, Karabar-Burnis and Neyman, for example, they kind of like look at two steady states if you want, and you know, it's kind of like hard to think about this transition. So we think that this concept can be useful. And just let me finish by saying that in the baseline model that we'll present, there's no nomothetic preferences, but again, like the presence of nomothetic preferences in general precludes the existence of a balanced growth path along when there's like a structural change, right? So you may think about the paper by Kong-Samud prevalence here that, you know, unless you have like a very knife edge condition, you're not going to get balanced growth, right? And so, you know, like kind of like a broad characteristics that all these models have is that, you know, asymptotically, you know, as time goes to infinity or minus infinity, like these things kind of like converge to something that you can characterize. But, you know, like the interesting thing is happening in between, right? And it kind of like you have like non-stationarities. And so in these type of settings, the strap can be useful, okay? So with this claim to kind of like a broader set of applications, let me now refocus back to our main application of growth and structural change. Okay, so what I plan to do in the next 22 minutes that I have is first I'd like to introduce the model. Okay, and I'll go just flesh out the main ingredients, and I'll go into a little bit of detail just to show where the balance growth conditions are going to fail. Okay, and these are going to help me to motivate the strap. And then I'll spend some time in a closed form example, just to add intuition across. I'll briefly state some like theoretical results we have, and then I'll conclude just showing you like some quantification of the model. Okay, so let me jump to the model environment. So this is going to be, as I said, a growth model with a structural change, and it will have three sectors: agriculture, manufacturing, and services. Okay, so each sector is going to be produced by a representative firm that uses a Cobb-Douglas technology, and each sector will have a differential productivity growth. Okay, then we'll have a representative household that is going to have a CS aggregator across all these like three types of goods. Okay, and a constant intertemporal elasticity of substitution across periods. Okay, and it's going to supply inelastically labor, so kind of like simple and fairly standard. And then on the investment side, there's going to be a representative firm that's going to be producing an investment good that is going to be as well a CES aggregator of agriculture, manufacturing, and services. And this is going to be a closed economy. Okay, and perhaps if you're familiar with a recent paper by Herendorf, Rogerson, and Valentini, so that's kind of like a three-sector rendition of their work. Okay, so the household intertemporal problem, it's going to look standard. So you have, like you're maximizing the sum of the flow utilities that you get, with this constant intertemporal elasticity substitution. And so here I just want to pause for a second and let me just, I've written the budget constraint a little bit just without normalizing prices, and I've done this on purpose because this will help me like to illustrate the issue of the balance growth path. So let me just walk you through that. So as like we have like this household that supplies labor inelastically, it gets some labor wage, it gets some returns on the capital it has, and then there's going to be some assets in zero net supply that will help us price the interest rate, right? So, and that, like it's here, everything, like these are going to be measured in consumption units. And then what can you do with your income? Well, you can either like spend in consumption, in investment, or in these bonds. Okay. And there's going to be a law of motion for capital, which tells you that the changes in the capital stock are driven by how much you invest. That's denoted by X minus the depreciation. Okay, fine. Now, let's look at the intratemporal problem. So as I said, there's going to be three sectors, and the representative consumer likes the three of them. And it has a CES aggregator across these three. And so, so here we're denoting with C sub J, how much you consume of each sector, and with capital C, like the consumption aggregator. Okay, so things to notice are two. First, you have like these weights denoted by omega. Okay, keep those in mind. And then there's going to be like some elasticity of substitution denoted by sigma C across these three sectors. And in line with the literature, we're going to assume that these three sectors are complement, meaning that you want to consume them, more or less in equal sizes if possible. Now, the investment sector is going to kind of like look similar. It's going to use like as inputs as well, like agriculture, manufacturing, and services. With a CES aggregator, is going to be three differences with the aggregator for consumption. First of all, there's going to be like this Higgs neutral technological change parameter. So like there's going to be like some differential productivity growth. And the aggregator itself is going to be different for two reasons. The weights that these omega weights that that CES has for in investment are going to be in principle different, and they will be in the calibrated model as they are in the data. And then potentially this elasticity substitution is different as well. Okay. All right. And then also in line with the estimates, we like this elasticity substitution. We're going to think of this as being complements. All right. Now, I told you like how the aggregators work. Now, how like these three, like the sectors that go into the aggregators are produced. Well, so there's a representative firm. It's a competitive environment, and it's very, very, very simple. So this production function is Cobb-Douglas with the same factor shares alpha for sectors. So all of the sectors have the same factor shares. Okay, and the only difference across sectors is this TFP that varies across sectors and grows at different rates. Okay. And so we're going to assume that agricultural productivity is faster than manufacturing, and manufacturing is faster than services. Okay, so because we have like this CES world, right? So if you think, if you kind of like run this model kind of like, forward, right? So like as Engay and Pissarides show, like the economy is going to be dominated by the sector that has the least productive sector, in particular here, services, right? So, as t goes to infinity, this economy is just going to be composed basically from services. Is going to look almost like a one sector model with services in which you have a balance. Conversely, if you were like to look back and look further back in time, like this economy would be mostly composed, made out of agriculture, and that limit to have a balanced growth, like effectively a one sector model. Okay, now let's look at the law of motion for capital now, and let's think what it would take to have a balanced growth path. So here, I've just rewritten the law of motion that I showed you. Okay, and so if we want the rate of growth of capital to be constant, right? There's some JK. So first thing we realize is that investment and capital, so this term over here, has to grow at the same rate. Okay. Another thing that is important to realize is that, now moving to the second part of the equality, is that output and consumption expenditures, when they're measured in units of the investment good, right? So these terms over here, if you want, right? They have to have the same growth as capital. Okay. So that's kind of like a requirement for to staying in the balanced growth path. And let's keep this in mind. Now let's look at the Euler equation. Okay, and let me write the Euler equation in terms of units of investment good directly. Okay, so that's how like this, basically, I'll just take consumption, excuse me, and multiply it by the relative price of consumption. Sorry. So what you get is this Euler equation. Okay, so if you wanted to have this thing to grow at a constant rate, because we know like from the previous equation that that's something that we need to grow at the rate that's like capital. Okay, so if you want this thing to grow at a constant rate, what this Euler equation tells you is, well, you need two things in general. So first, you need that the rental price of capital in units of the investment good, it has to be constant, and second, like this term would have to be constant. So either you have a unitary elasticity of substitution, recall theta is the intertemporal elasticity of substitution, such that this term would vanish, or you have that the relative price of investment grows at a constant rate. Okay, so is this possible in this model? Well, so let's see. Okay, I already told you that we don't want to like tie our hands to have theta equal to 1. So let's see whether like we can have like investment growing at a constant rate or the interest rate being constant. So let's look at the investment. So that's the formula that you get for investment, right? And so in general, the answer is no. Why? Well, because if you recall, we have different sectoral growth rates, right? That will translate in the growth of sectoral prices, right? And so we have CES aggregators that have different weights and potentially different elasticities of substitution. So in general, we will not get a constant growth in relative investment. Okay. Now, what about the rental rate? So so the rental rate, so it turns out that like you can express like the total investment in the economy. You leverage the Cobb-Douglas structure, and you can express it as a Cobb-Douglas of the total amount of capital and labor that is being produced in investment goods times like this kind of like endogenous TFP, which has like this CS form. Okay. So then you can take like the first order condition here, and basically, because we know that capital has to grow at a constant rate, and this thing has to be constant, then this would require this thing to grow like at the same at the rate of capital to the power of 1 over alpha minus 1, right? But so that again is not going to be true, because like if these things each sector grows at different rates, and so in general that's not true unless you pick like knife edge conditions. Okay. So all right, so all of this is to say that like in general, like even like this very simple model, it's kind of like hard to get like like generically you're not going to get a balanced growth path. Okay, so how would you define a competitive equilibrium here? So you would kind of like specify some initial capital, some path for productivities going forward, and then you would find for allocation on prices such that basically households maximize utility and firms are optimizing as well, and you have a transversality condition. So the thing that I just want to, so that part is super standard. The only thing I want to emphasize is that here, in order for thinking about the standard competitive equilibrium, you have to give me an initial capital, and then you kind of like solve the model forward. Okay. So now let me look at the solution of this model in one particular example. For like, I looked at the competitive equilibrium of this model in a particular case in which the factor shares the capital intensity is equal to the inverse of intertemporal elasticity substitution. Okay, so formally that's alpha equals to theta, and so this case is kind of like well known because it allows you to kind of like decouple the system of differential equations that you get. Okay, and so after normalizing consumption and capital by like this endogenous like TFP of the investment sector, okay, you can show the following result, which is the policy function that you get for consumption. It just it's basically kind of like tells you, well, so you give me like the solution for capital, and you just have to multiply capital by a factor, right, that may be time varying, and you're going to get consumption, right? And so one property of this model that is related to the fact that I was telling you that as you look, as you go forward, you kind of like converge to service only economy, is that asymptotically you have a balanced growth path. So asymptotically you get that this M is independent of T, right? So that's kind of like the result I'm saying here. Okay. So more importantly, okay, like this, what remains to be discussed is the role, like what happens with capital here. So capital, the solution for capital is a function of two things: time and the initial capital level, right? And what we're going to see is that this solution basically has two terms. So one term, okay, kind of tells you, okay, you take the initial condition, K0, okay, and look at this solution relative to a function, okay, that relative to a function that I'm going to discuss more later on, okay. And so you have like this term, okay, and this term is going to be weighted by this mu, all right. So, and then you'll have another term that is again this K star function that depends, it's evaluated at T. So what this means, right, is that if you want to know capital tomorrow or like 10 periods from now, basically the time dependence will come, or changes over time will come through like this K function and this relative, this mu function over here. So one thing that one can show is that this term decays exponentially, so it decays kind of like relatively fast. Okay, so what this means is that this kind of like this, this term that is multiplying the initial condition, its importance is going to be declining over time at an exponential decay, right? And so the medium run properties of the dynamics of capital are going to be basically determined by this K star function. Okay, and so what can we say about this K star function? Well, so one thing that is very, very, very important is that this K star function is independent from the initial condition of K0. Okay, so regardless of where you're starting, the initial condition that you give me to solve the competitive equilibrium, I'm going to find the same K star. So once this weight is sufficiently small, this first term, right, it's going to carry less and less weight, and the dynamics are going to be pinned down by this medium run function. Okay. Moreover, what we know is that this K star function is going to converge asymptotically if you go forward to as if you only had services in the economy, and if you actually were to take the limit as t goes to minus infinity, you're going to get the steady state capital as if there was only agriculture. Okay, so so this K star is just going to be essentially what our strap is going to be in a much more general setting. Okay, so and just to convey the intuition, let me just show you a phase diagram. Okay, so in this phase diagram, what you have here on the x-axis is the normalized capital, and what you have on the y-axis, you have normalized expenditure is C. Okay, that you think about as C. Okay, so what you have here, these two dots are some, so these correspond to like standard balance growth paths to where like this economy is going to converge as t goes to infinity or minus infinity. So that's the service VGP. That would be an economy where you have agricultural VGP, right? And so the K star function is this line that is connecting the two balance growths, okay? So so what I've plotted here, for example, is the initial, what would happen like the dynamics to like if, I give you like some capital that, that it's not on this K star function. So you can see that, like kind of like this gap over here, if you recall, you can think of this as like the difference between the K star, this term that like the first term that was capturing the initial conditions, right? And then that was weighted by this like like this mu t0 over mu t, that it's kind of like this term is disappearing, is going to 0, right? And so like this difference between the medium run, this development path and the initial condition is kind of like narrowing, and basically essentially you're kind of like like the medium term dynamics are completely pinned down by K star. Okay, likewise with another example. Okay. So this is kind of hopefully has set the stage to make it intuitive how we define this stable transformation path. Okay, so in the stable transformation path, we replace the initial condition that you give to a standard competitive equilibrium with another boundary condition that basically you have to come from a balance from a balanced growth path and you have to end to another balanced growth path. Okay, so formally, right? So given a path for productivities, the stable transformation path is an allocation and prices such that households and firms are behaving optimally, but that you satisfy the following two asymptotic conditions. As time goes to infinity, you converge to the steady state capital of the service-only economy, and as time goes to minus infinity, you converge to the steady state of agriculture-only economy. Okay, and what we can show in general is that this path exists and it's unique. Okay, under like some regularity conditions. Okay, and I want to emphasize that this proof actually is for a much more general model than the example. Okay, so the proof that we have, in fact, nests the examples that I was mentioning in the introduction. Okay, so basically, just to reiterate, so the key difference of the strap is that it replaces the initial condition for capital that you have in the competitive equilibrium with a boundary condition basically going forward. You have to come from a boundary. Okay, so so basically, at each point in time, or for any vector of productivities, there's only one level of capital that is consistent with the strap. Okay, so that's the key. And importantly, so as I show you in the example, right? Like you are going to converge to this strap if you don't start on it, right? And then you can think about like the thought experiment where you start at a given point in time for like certain productivities with different levels of capital. So there's going to be like some transitional dynamics that are going to be like relatively fast, and then you're going like the rest of the dynamics are going to be basically characterized from the strap. Okay. All right. So in the last 3 minutes, let me then show you a quantitative exercise where we calibrate the model that I just showed you to US data post World War II. Okay, and here I just want to emphasize that basically we allow the TFP of each sector to grow at different rates. We allow the CS aggregators to have different weights, okay, and the intertemporal elasticity to be different from one. So we don't have balanced growth path, only asymptotic balanced growth path. And of course, like then we're going to solve for the strap, so we don't have to think about what what is like an initial capital level. Okay, and so then you can solve using like a shooting and then forward and then backward algorithm. So it's actually it converges fast and it's simple. And I want to first show you how like this thing looks like, and then I'll do 2 exercises. I'll show you first that by thinking about the dynamics generated by the strap, you're going to get things that are going to look different from like the case of intertemporal preferences. So for example, the investment rate is going to become qualitatively different, and afterwards, I'm going to look at the cross-country data. Just look with the US calibrated strap and see how whether this has like some any like bite in explaining the growth process. Okay, so so this is the simulation results. that we have after the calibration. Okay, so as I told you first, we're using post-World War period data. So basically, that's the part of the like the years that we're using for our calibration, right? And so the first thing to note is like kind of like, not surprisingly, the model across sector generates this kind of like a well-known pattern of a ham shape in industry. Okay. It generates, in terms of growth, it generates a decline on growth. So that's kind of like natural because productivity growth, we said it was faster in agriculture and slowest in services. So it's this kind of like Baumol thesis type. But at the same time, you have investment growing along the growth path. Okay, so this kind of like is a countervailing force. What would happen if you were like to look at some knife edge cases? And so here, in the interest of time, just let me mention two. So if you were to make the intertemporal elasticity equal to 1, so you have the log case, okay, you would get like an investment rate that is declining over time, which is counterfactual. I'm going to show you at least like if you look at cross-country data. If you were to make that the investment sector only uses manufacturing, in fact, you would predict that growth has been, slightly increasing over the last 300 years. Okay, so so these, of course, are qualitatively and quantitatively very different from the benchmark. And so in the last, sorry, I realize it's like I'll take just 3 minutes to kind of then like say, okay, so now I've looked at the time series for the US. Let me confront this with cross-country data. Why? That's an interesting exercise because like the strap is informative about the development process. So I'm going to use cross-country data to kind of like look farther back in time, if you will. Okay. So so here, what I'm showing you on the in black is basically Penwell table data on 10-year growth rates, average 10-year growth rates. Okay, so the line is just the fit of the data, and the dashed line is the 25th and the 75th percentiles. Okay, so what you see is that as a function of income per capita, growth rate is declining. So that's a well-known fact. And what is the prediction for the US calibrated? So the US calibrated strap. So in fact, so basically you have to think like over this time period. So like over the post-war period. So the US, it's basically just like what I was showing you, or it's just like this part over here, right? So this part over here, if you want this out of sample, and you see that kind of like gets pretty close to the evolution of the growth in the cross on average in cross countries. And just to pick, so as a way of comparison, if you were to just have like the neoclassical growth model, and you were to initialize it with a capital level that so what you would get is just a very, very like a much faster like initial growth, and then a much faster convergence. Okay. This decline in growth that it's like that happens with this Baumol disease. Okay, at the same time, you have like an increase. It's offset with like increasing capital output ratio. So here again, I can show you what happens in the sample. It kind of like goes up, and then the strap kind of like reproduces this upward tendency, but not all the way, right? And here is just you have like the neoclassical growth model, of course, would do worse. Okay, and just to conclude, something else that we have not targeted here, except for the US, is what happens across sectors. So here I'm using like data from a bunch of countries again in the post-war period, and I'm plotting the strap on with darker dots for the US, and I'm projecting it backwards again. And what you see is that despite not targeting the evolution of like the composition of the economy, that kind of like the strap kind of like gets it right more or less on average. So just to conclude, what do we do in this paper? So as I said, we do two key things. So the first, and probably for most, is introduce this concept of strap that captures these medium-term dynamics. Okay, so in this path depends on like the of course the model structure and the technology vector, but it's independent of initial conditions, and as such, it kind of like captures like these medium-run dynamics. And then we apply it to a model of growth and structural change, and we show that it can generate like some of like the key facts, or can perhaps not all the way, and what I've shown you for the investment for capital over Y, but for growth, for example, it has like this, captures very well this protracted behavior. We believe again that it's useful for analyzing other dynamic growth models, like, and to think about the decline of the labor share and so forth. And just as a pun, so the next time that you see a model of a structural change, you should ask for the strap. And that's all I have. So thank you very much. Very happy to take questions at this point, and or by email afterwards and so forth.
Thanks, Marty. So indeed, we have about 11 minutes for questions. So Harold?
Yeah, so just technically, I mean, we could take a standard neoclassical growth model where we just have one sector, right? And there's a balanced growth path, and usually that's expressed by some relationship between K0 and the productivity at that point. And I guess because, once you're on the settled path, stable path, you could also express it by just taking the initial capital, going back in time and demanding that, because it's backward unstable, forward stable, right? So if you extrapolate it backwards in time, another way to express this balanced growth condition is that it has to converge to, that essentially that expression that you had, it has to satisfy something at minus infinity. If you started, so I think the initial starting point in the balanced growth path for the standard neoclassic growth model can probably express the same way as you do here, instead of there's sort of an initial boundary condition, if you like, whether it's at date 0 or minus infinity is fine. Now, what surprises me here, and maybe you can comment on that, is you're having 3 sectors. I mean, I can see how this would work with 2 sectors, but with 3 sectors, I'm sort of surprised, because you still have to sort out, in essence, how much manufacturing, how much you do with manufacturing, how much you do with services, when it's all about the agricultural sector that you pin down when you go back in time.
So, okay, so that's an excellent comment. And so I guess one fundamental difference, if you think about the neoclassical growth model, I guess, you would converge, I guess, to 0. Whereas here, like, we're kind of converging to another balanced growth. But I think that's a very interesting analogy where we can, so perhaps we can push more on that. And so, yeah, so the kind of like, let me show you right, with like this ES structure, right? So basically you can show that, as you take the limit, right? So okay, so let me show you like the key assumption that we're making. And so, right, is basically that, like you have constant productivity growth that across sectors that are ranked, right? So, and so because of that, basically, when you take the limit, you can always show that because these inequalities are strict, actually you could have like an arbitrary number of sectors, and you're still going to have like these well-defined properties, right? So for example, okay, and so here there's this, and there's the fact that both the investment and consumption aggregator are complements, meaning that, like these 2 things go like on the same direction, right? So for example, if that, like if you don't have this, you could have like, kind of like somewhat like, like richer dynamics, or for example, if you have like non-homostheticities, and it just so happens that, like, anyway, yes. So that's how you get it. Yes. Yes. Okay. But let me just emphasize that the strap result, it kind of like requires like some stationarity in the limit. That's really like the requirement. So I've kind of like perhaps, yeah, that's, yeah. I'll stop here, and I'm happy to talk more about this. We've thought quite a bit. But
or maybe if, let's say you have 4 sectors, you're having 2 boundary conditions, it looks like. I'm not even sure that if you go to the definition, right? I mean, can go to,
yes.
So
here.
That's
sorry.
right.
Yeah, here, yes.
Right, you're having 2 boundary conditions. Actually, kind of wondering whether the top one is really necessary, or do we have that boundary condition for all the sectors? Maybe that's a key here. I don't know.
No, because you can show as I was telling you, so actually, so here you actually have like kind of like all sectors, and like the property that we require is basically when you take this limit, like this thing over here, eventually, it looks like it has kind of like a constant growth. It can be just dominated by one sector, or it could be, some convex combination of growth rates of different sectors. Okay? Once you have that, okay, then if you look at the Euler equation and the law of motion for capital, so basically it becomes an independent of time. So, and then you can show that there exists a steady state. And so that's how you then, the solution of that is, it's this K upper bar. That makes more sense this way?
Yeah, but it's only one sector at the limits, right? And so, but you have three. I guess that's what I want. 4 or 5. That's
fine. No, but then that's exactly right. But that's the beauty, right? That's kind of part of what we find it's cool. So right. So here, along the transition, you have the rise and fall of manufacturing. For example, if you have like 4, you could have some like multiple humps, and that's actually possible. Yes. And still, and you still are like
Other questions? Hélène?
Yes, thank you very much. So, so the investment rate here. So I thought one stylized fact was investment rate going down, so is it due to the fact that you have capital intensity? I mean, in the 3 sectors, I mean, you have an extreme assumption on the your control parameter is the same across services and manufacturing and agriculture, I think, right?
Yes.
So that doesn't seem a very satisfactory assumption.
We're on board. So that just yes, I agree. So,
but can you relax that easily? I mean, because
yes. So for example, you could have actually we show it in the paper. So you could have. So, for example, the Acemoglu Guerrieri JP paper where they have different factor shares. So, we show it how to do it. On the investment rate, yes, I don't know. So I'm not, to tell you the truth, I'm not a specialist, but so I know like the Xia and Clino that emphasize kind of like the flatness. Some other people have emphasized like that it increases like overdevelopment. So perhaps we can discuss this more offline. But so. One thing that I want to remark is that, like B, whatever it may be, right? So, like through the lens of the strap, you can actually choose, like, you can think, well, what is the intertemporal elasticity substitution that is going to be consistent with whatever, like, you think the investment rate is, right? So for example, here, like if you were to make like theta less, so this is theta greater than 1, this is theta equal to 1. To tell you the truth, I think we've done it and I don't remember. I'm conjecturing, theta less than 1, it's going to give you perhaps, like more decline. These I'm not sure, but you're going to get like this type of a heterogeneity. There's this, you could have, these differential factor shares across sectors, which off the top of my head, I would have, I cannot think exactly how they would translate in the investment rate, but yes. So, but I guess what we had in mind again is like we thought, that we were kind of like targeting about the investment rate as a function of income per capita was something like that. Which, I mean, I guess is from the Penwell tables, but happy to learn more about it, and yes, for sure.
Can I ask a question? Hi, this is Kiminori. Hi. So I'm trying to understand this notion of strap, for more, try to put it in a more general context, or at least the context I'm familiar with. So think about the cases where just you write down, say, neoclassical growth model. Mm-hmm. So, and the things converge to the just a unique steady state. But imagine that instead of writing down just the one sector model, let's say you write down a 2-sector model with a 2 capital stock.
I see. Okay, so I can get pretty close to that. Let me see if well, yes. Let me see if I can click here and then show it, because that's, so you're thinking.
Yeah, but let me, can I just finish?
Oh, sorry. Yes. Of course.
Okay. So there's a 2 capital stock, and usually this kind of a model has some stable manifold that converge to the unique steady state. If once you on that stable manifold, you converge to the unique steady state. Mm-hmm. But when they're actually, if it's or there's only one capital stock, that the stable manifold is 1 dimension. But suppose you have 2 capital stocks, mm-hmm. It's 2 dimension, right? So the stable manifold is actually 2 dimension, And on it, there's a unique steady state that it converges on this two-dimensional space. But it always approached from, asymptotically always approached from particular angle, in the sense that there are two, stable eigenvalues, but asymptotically only the one that has the largest eigenvalue will essentially determine the how it approaches the steady state. Is your stable strap is actually related to this sort of a dominant eigenvalue path?
No, actually no. And so the notion of stability is the thing that we've been kind of like struggling the most to provide a good mathematical foundation. So basically, I think like what you have in mind is like, yes, when you have like this multidimensional manifolds, right, and you kind of like log linearize around it and look at the how you approach this balance growth. Right. Kind of like the focus that we want to have is precisely not this one. We want to have a focus kind of like away from the balance growth and kind of like think like models that are going to generate interesting dynamics when like precisely this log linearization is something that you don't want. And so that's like here, like we can show formally like existence and uniqueness under like some regularity conditions. But then like this notion of convergence that, for example, I could show you like in this very simple example, kind of like in closed form, and that it had exponential decay. For more complicated models, right? For example, like the model that you're saying, and let's just suppose that, underneath of like these two technologies that you have, there's like some process in which you perhaps asymptotically grow at one rate, then you transition and you go to some other rate, such that the economy, like when I take the limit to go into infinity minus infinity, has like a well-defined balance growth. So for this type of cases, I cannot, I don't have like any result for like, which I could say, I don't know, something about the half-life or something along those lines. So we've relied mostly on simulations, or we have to rely mostly on simulations. So that's something that we have not. And part of the reason is it's kind of like, to do that, you would have to, in a way, kind of like detrend for the strap. And that's actually, so we can show that it exists and it's unique, but like the detrending itself, except for particular cases, it's actually, it's pretty hard because we don't know like the expression. And so I guess it's something that we have to think more about.
Okay, well, thanks, Marty. There will be some time in the break if you want to continue this conversation. Thanks for the presentation and the discussion. And now we will turn to the next paper about the central bank digital currency. And I think Linda is presenting.
Yes. Can I share my screen?
Sure. Yeah, go ahead.
Please.
Can you see?
Yes.
The slides are moving. Wonderful. So, okay, let me get started. Thanks so much for putting the paper on the program and for having us in the plenary session. Okay, so this is joint work with Jesus and Harold, who are both also in the audience, I believe. Okay, so just to bring us all on the same page, this is a paper on central bank digital currency. What is central bank digital currency? So you might have heard in the news, when you talk to policymaking institutions, there's a lot of talk about CBDC nowadays. And what is interesting is that the term CBDC means something different to whomever you are talking to potentially. Yeah, so a CBDC can be a payment system, a new digital currency. And in this paper, we will talk about CBDC as interest-bearing accounts that citizens can hold at the central bank. Yeah, so these are accounts to which citizens have 24/7 access at the central bank. Okay, so what's the idea of the paper? The idea stems from the following observation. We know that central banks have an intrinsic price stability objective. So want to target a particular inflation level. But at the same time, we have been observing that also before the pandemic already, central banks have been running a quantitative easing on large scale. And as soon as they would start offering CBDC accounts, central banks certainly enter into the business of financial intermediation. Not only that, but So as the same set of co-authors show in a different paper, we show that as soon as central banks start offering CBDC accounts, this can in fact drive business away from private banks to the central bank in terms of deposits, so that deposits, central banks become really large in deposit making. Okay, and so this just to point out that well, the central bank will have to confront different kinds of objectives at the same time, namely the standard or the traditional objective of keeping prices stable, and now classic objectives that come with financial intermediation. So we know that since Diamond and Dybvig at the latest, that financial institutions that offer maturity transformation can be prone to runs and have an objective in providing the optimal amount of risk sharing. And so the idea is to see how these three objectives can be accomplished at the same time, whether this is possible at all. Okay, so just upfront, what's the key result? We show an impossibility result. So these three objectives cannot be attained at the same time. So we call this result the CBDC trilemma. What we are going to do is we are fixing each of these three objectives, and then we will show that at least one other objective will not be attained. And so what's to us, the most interesting result is the following. So if you, okay, we will show that the central bank will always be able to provide the optimal amount of risk sharing and to offer a run-proof contract, but only by credibly giving up the price stability objective. And so the result is interesting from the following perspective. We know from Diamond and Dybvig that banks that offer the optimal amount of risk sharing, they are prone to runs. And so there is a bad run equilibrium in which the optimal allocation is not attained. And we show today that the central bank can overcome this dilemma and can always implement the social allocation dominant strategies, but only by threatening with inflation. And so what's the key mechanism here? This is the inflation threat. And we will see that runs on the central bank can manifest themselves in form of runs on the price level. So it's a new form of the run. Okay, so just briefly on the literature, we are building on Diamond and Dybvig, and there exists already a large literature on nominal banking, so nominal contracts, and so on. Our main contribution is that the central bank here is a strategic player that is going to steer the incentives of the depositors through the inflation targeting. Okay, and so since we are building on Diamond and Dybvig, let me exactly start out with the Diamond and Dybvig 1983 model. Okay, so you have 3 time periods and a continuum of agents. So these agents are small and at time 0 symmetric, each endowed with 1 unit of a real good. At time 1, then, these agents become asymmetric because they learn something about themselves. They learn whether they will be patient or impatient. Impatient means the agent learns that you will die in the same time period and instantly has to consume. If the agent turns out patient, then the agent knows that she can also consume at a later time period. Yeah. Otherwise, the agents share a common utility function, strictly increasing concave, relative risk aversion greater than 1. Then there's a unique production technology in the economy, and this production technology looks the following way. So it's a safe technology, there's no risk. For every unit of a real good that you invest at time 0, the technology yields 1 unit in return when liquidated at time 1. And you see already here the issue that from time 0 to time 1, this technology is a storage technology. There's no strictly positive net return. And this will make things very tricky for the impatient types. Now, if you stay invested in the real technology for another time period, then this technology pays off a very high return, capital R, greater than 1. Okay, and then there's a storage between 1 and time 2, because patient agents generically would like to consume at time 2, but because there's storage between time 1 and time 2, they can also decide to technically liquidate at time 1. Okay, so what Diamond and Dybvig show then is So just put yourself in the shoes of an impatient type. All these agents only have access to this real technology here, meaning that all agents at time 0 will invest. At time 1, they then learn about themselves, whether they are patient or impatient. And then the impatient types, they instantly have to consume because they will die. So they are going to liquidate the technology and essentially made zero net return between time 0 and time 1. And so this is so traumatic for these agents that Diamond and Dybvig show optimally at time 0, all agents would like to write a contract which looks the following way. So this contract would specify an allocation for early consumption at time 1 that exceeds 1. Yeah, this is more than the technology would yield. Paying this allocation greater than 1 is possible because only a certain fraction of the agent population will turn out to be impatient. Now, so Diamond and Dybvig show that banks can offer this kind of optimal allocation by pooling resources at time 0, investing in the technology, and then at time 1, impatient types are going to walk to the bank and say, hey, I'm the impatient type, give me X1 star greater 1. And then the bank will say, okay, you're impatient, you claim to be impatient, I give you X1 star. And so as long as agents behave according to their type, this is in fact going to work. So the bank can offer the optimal allocation. What Diamond and Dybvig, however, also show is the existence of a so-called bank run equilibrium. And this works the following way. Imagine you're a patient, which means that you can technically also consume at time 2. But now look at the following. If you believe that many other agents will claim to be the patient type, will claim to be the impatient type, and walk to the bank at time 1, all demanding X1 star, then the bank will not be able to deliver X1 star to everyone, simply because the technology in the short only pays like a storage technology, not greater than X1 star, not greater than 1. Therefore, if a patient type believes that many other patient types will act as if they were impatient and walk to the bank, also I, as the patient type, will walk to the bank early and demand X1 star, even though I could consume late. Not only that, but if many of us patient types believe that many other patient types will mimic the impatient type and walk to the bank, we're all going to run on the bank at time 1 and be demanding X1 star, and this is going to cause the collapse of the bank. So this is a self-fulfilling panic run. So this is what Diamond and Dybvig show. Yeah, so they show if the bank offers the optimal risk-sharing allocation, then if everyone behaves according to their type, the optimal allocation is in fact implemented. But if many agents mimic the impatient type, then there's a bank run. Yeah, so the offering the optimal allocation makes the bank fragile. And we show in the paper today that the central bank can overcome this dilemma using nominal contracts. Yeah, so the central bank will be able to implement this X1 star in dominant strategies. But now how? Okay, so what do we do? Okay, so the central bank is going to offer now nominal contracts. So the agent is still endowed at time 0 with 1 unit of a real good, is going to walk to the central bank, and the central bank will offer in return a contract that promises M units of CBDC if the agent spends early at time 1 on goods, and the contract offers M times 1 plus I units of CBDC if the agent spends late at time 2. Okay. Now, what does the central bank do? At time 0, all the agents hand over their real goods investment, their real goods endowment. The central bank pools these resources and invests in the same technology that I've shown you in Diamond and Dybvig. So this is a real technology, but contracts are nominal. At time 1, then, the agents' types reveal, and the agents decide whether to spend or not. And the central bank is going to observe aggregate spending behavior before she decides to liquidate, before she decides on the fraction to liquidate of the technology. And so depending on how much she liquidates, this is going to determine the real goods supply to the agent. And then there will be a price level, P1, that clears the market at time 1. At time 2, then, the remaining investment is going to mature at the high interest rate. This will be sold to the agents that decide to spend their CBDCs late. And then there's a price level P2 that again clears the market. Okay. So how do we define a run on the central bank then? We do this for now in a very abstract way. We simply say a run occurs if not only the impatient types decide to spend early, but there are also patient types that are spending CBDC. And this means there is strategic spending going on, and we still have to figure out when this would be the case. Okay, so let's go into the details. Let's have a look at the market clearing. So at time 1, there is a share of agents that decide to spend early, and each of them spends a quantity M of CBDC. So what you see here is the total amount of CBDC that is brought to the market, nominal spending. On the right-hand side, then, you see the amount of real goods that the central bank is going to provide, and P1 is the market clearing price. So this is the nominal value of goods in time 1. And likewise, at time 2, you see here the remaining agents that spend late, each of them spending this amount of CBDC. And here you see the total amount of goods supplied in time 2, and this the price level. Okay. Now, let's have a look at market clearing and what the price levels are supposed to satisfy. You see here instantly that the price levels are far from being stable. In fact, they're fully flexible to the aggregate spending behavior of the agents. Yeah, you see here. This is strategic spending. The total supply of agents that are spending in terms of CBDC, and also the central bank. So the quantity of products that are supplied by the central bank is important for determining the price levels. Yeah, so far these price levels are absolutely flexible. Now let's have a look at the micro incentives of the agents. When would a patient agent decide to spend early rather than late? Well, what is the real allocation to an individual agent at time 1? This is simply the amount of products that is provided by the central bank at time 1, divided by the share of agents that decide to spend early. In contrast, the real allocation at time 2 is just goods provided at time 2 divided by the share of agents that spend late. And so what you see here, remember that the central bank, again, is not going to go to tell apart what agent is patient or impatient. Yeah, these types are not observable. But the central bank will be able to use a different tool. You see here that if the central bank strategically sets the goods supply or the liquidation at time 1, she will be able to steer the patient agent's incentive to spend early rather than late, simply by shortening the goods supply. Okay, so what's an equilibrium? We at first define an equilibrium as a spending behavior N, initial money supply, a liquidation policy, and a nominal interest rate, and price levels. Yeah, there I should emphasize the central bank policy is set at time 0, and the central bank fully commits to this policy, such that at time 1, individual spending decisions by the agents are optimal given the announced policy at time 0. Yeah, so, and given the price levels. In time 1, then, given an aggregate spending behavior by the agents, the central bank will in fact liquidate the according amount that she announced at time 0. Yeah, so at time 0, she's announcing the schedule, a liquidation policy for every possible level of spending. And then at time 1, given the amount of spending, the central bank will indeed liquidate the according amount of goods and set the nominal interest rate. And then given spending behavior and the liquidation policy, the price levels are going to clear the market. And you see instantly here, so the price levels are again flexibly adjusting to the aggregate spending, the money supply, the liquidation policy, and so on. So they are far from being stable at this point. Okay, so then let's talk about equilibria. When would it be the case that it is an equilibrium that only the impatient types are spending? So this is what we actually want to accomplish. We want only the impatient types to spend early. Well, this is an if conditional on only impatient types spending, the individual allocation of spending late exceeds the individual allocation of spending early. Yeah, so this is important to deter the patient types from spending early. The allocation at time 2 has to be larger. Now, when you ask the question the other way around, when is it ever the case that a central bank run is in equilibrium? Well, this holds if conditional on all agents spending early, indeed the allocation at time 1 exceeds the allocation at time 2. So that would mean that patient types are in fact rewarded ex post for running on the bank. Yeah, this causes the run to be in equilibrium. Okay, now the central bank comes along and of course tries to engineer that this bank run equilibrium cannot happen. And the way to do it is to steer the liquidation policy. Yeah, so this will be the key, the liquidation policy of the real technology. Okay, so how can the central bank implement these social optimum and dominant strategies? Well, this works the following way. Remember, the central bank first observes aggregate spending and then liquidates. Therefore, if the central bank observes that only impatient types are spending, then the central bank will liquidate the optimal amount so that she can supply the optimal individual allocation to the impatient types. But now, if the central bank observes that also patient agents are strategically spending early, then the central bank will take care that the allocation at time 1, in fact, undercuts the allocation at time 2. So this is going to cause the spending decision to be ex post suboptimal. Yeah. Now, how can the central bank implement this policy? Well, we call a liquidation policy run deterring if for high spending behavior. So if the central bank observes agents are spending early, the central bank is going to reduce the goods supply at time 1. So, and this is going to cause the patient types to regret their spending decision, essentially. Yeah, so it's, yeah. And so how does this mechanism work? Remember that liquidation policies are announced at time 0 already before the agents make their spending decision. And if the announcement is credible, then in fact, such run deterring policy is going to deter the run ex ante. Yeah. So this threat here to reduce the goods supply is an off equilibrium path threat, and on equilibrium, it will in fact not happen. So it's not executed in equilibrium. And just to show you in a graph what these run deterring policies look like. So you see here on the x-axis, here is the measure of impatient types. So in equilibrium, you would always see at least lambda agent spending at time 1. And as soon as you see spending above lambda 1, you know that there's strategic spending going on among patient agents. So the red line here can be understood as, so remember, a liquidation policy would have to pin down a liquidation level for every possible spending behavior in this range. As long as the policies that are announced by the central bank are below the red line, this policy is run deterring. There will be no spending behavior, no early spending behavior by patient agents. But if the central bank would exceed the red line at some point for some possible spending behavior n, then the liquidation policy is no longer run deterring, and then it can be that patient agents strategically spend early, simply because the allocation at time 1 can exceed the allocation at time 2. Okay, so this is the first part of our trilemma, and I think it's the main result in the paper. For every policy choice that the central bank can set at time 0, which satisfies the following: if only the impatient types are spending, the central bank is going to liquidate the optimal amount of technology. But if also patient agents are spending early, then the central bank policy will be run deterring. So the goods supply will be short. Such a policy deters central bank runs and implements these social optimum and dominant strategies. Yeah, so in dominant strategies. So this is an improvement over dominant and big. Now, this comes at a cost. What's the cost? such a run deterring policy translates immediately into a commitment to run high price levels. So if there's strategic spending going on at time one, the central bank reduces the goods supply, and this instantly means via market clearing, the price level has to be high. Yeah, so there's no way to have a price stability here at this point. Yeah, so, and not only this, but so the central bank has to credibly announce the run deterrent policy, meaning it has to be credible that the central bank gives up price stability. Otherwise, the mechanism is not going to work. Okay, so this for now looks a bit like suspension of convertibility. What does this mean? So suspension convertibility is a classic policy tool in the bank run literature to prevent runs. It works the following way. So if depositors run on a private bank, suspension means at some point a regulator is going to intervene and simply going to say, depositors can no longer withdraw. There's a mandatory deposit stay, and all depositors that wanted to withdraw have to go home. They will get some payment later on. Okay. And so Diamond and Dybvig show that these kinds of suspension policies work to deter runs, in fact, ex ante. If I know as a patient type that the regulator will at some point intervene, then this is going to protect investment of the bank, and is going to lead to my allocation at time two to be sufficiently high. So there's no need for me to run on the bank. I could just as well just stay home. But our mechanism here is different, because the central bank in here does not deter agents from spending CBDC. Yeah, so there is no, essentially agents here are spending on a click. They also do not withdraw money. So they just spend CBDC on a click. Instead, the mechanism works through the shortening of the goods supply in the real economy. Okay. So I have around 6 more minutes to go. Now, so what I've shown to you so far is if the central bank is going to willingly give up the price stability objective, then we can implement the socially optimal allocation. There will be no runs whatsoever. But the thing is, central banks do have a price stability objective, and we are now reintroducing this objective and see what's going to happen to the depositors' incentives to run on the bank and what's going to happen with the socially optimal allocation. Okay, so we say a central bank policy is stable at a target P bar if it achieves the following. So the target should be attained for every possible spending level of the agents. So no matter whether only impatient types are going to spend CBDC early or also patient types, the price level should not move. This is going to restrict quite a bit the liquidation policies that the central bank can run. If you look at the market clearing equation here, price stability at time one requires that this level here is constant no matter the spending behavior N. So if you just plug in here the target, and if agents are still able to spend strategically, the central bank will have to liquidate accordingly in order to maintain the price stability here. Yeah, because market clearing will have to hold in any case. So the question is now, what restrictions does price stability impose on the liquidation policy of the central bank? And so here it is. Let me skip this. So a P1 stable price policy at a level P bar requires the liquidation policy of the central bank to be linear in the spending behavior of the agents. Not only that, but we know that there is a natural feasibility constraint that the central bank would need to adhere to, namely the central bank can never liquidate more than the entire investment. That's just not possible. So because the central bank can never liquidate more than the entire investment, this gives a restriction on the slope here. And this translates into a real allocation that is lower than 1. So just to let me show this in a graph. A price stable policy at time 1 requires a a liquidation policy that is linear and originates in the origin. Yeah. And you see instantly that the highest possible slope is 1. We cannot have a slope higher than 1 because here the central bank would need to liquidate more than the entire investment. That is not feasible. Yeah. So if the central bank would run liquidation policy as such, coming to this edge here, the central bank will need to stick to the upper bound. Yeah. And so then price stability would be violated. Okay, so what does this mean for us? Well, if the real allocation to an individual agent at time 1 is bounded from above by 1, this instantly means that the socially optimal allocation cannot be reached. Yeah, so socially optimal allocation means that to the impatient types of measure lambda, the central bank has to provide x1 star to each of them, and we know that x1 star exceeds 1. So we are at the second part of our trilemma, namely, if the central bank commits to a P1 stable policy, remember this means the price level is constant no matter how many agents spend CBDC. With such a policy, the social optimal allocation cannot be implemented. The good news is, however, that the allocation at time 1 is so low that patient agents are not interested in running on the central bank. So in the unique equilibrium, there are no central bank runs. Okay, now you could say, well, we are interested in implementing the socially optimal allocation. Is there a way to maintain a notion of price stability while also reaching a socially optimal allocation? So what we're going to do in the last 1.5 minutes is we're going to soften the price stability objective of the central bank. Remember, we would like to reach this point here. And with a fully price stable policy, this is not possible. So we say a partially P1 stable policy attains that either the price level is fixed at the goal for all spending levels, or alternatively, the entire real investment is liquidated. This means that we can run liquidation policies that are linear functions in aggregate spending behavior or are at 1 above. So it looks like this. This is a partially price stable policy. Yeah, so this means for low spending behavior here, we are at the price target. And for a critical spending behavior and C, the central bank liquidates the maximum that she can, namely the entire investment. So for even higher spending behavior, she cannot liquidate more. Liquidation remains at 1. And so here's the problem with these partially price stable policies. The partial price stable policy breaches the run deterring boundary. You see this here. This means that for spending behavior above the threshold here, the real allocation at time 1 exceeds the allocation at time 2. And therefore, for a patient agent, it would be optimal to spend early. So you have bank runs back as an equilibrium phenomenon. Okay, so this is the last part of the trilemma. Let me finish with that. So under a partially price stable policy, runs on the central bank can reoccur as an equilibrium. So there are 2 equilibria with in a no-run equilibrium, the social optimal allocation is attained. Yeah, so if you have a low spending behavior here, you can reach the optimal point, Y star. But on the other hand, if there's a panic, then all agent types are spending, and spending is ex post and facts suboptimal. Okay, so let me conclude. What I've shown to you is a nominal banking model for a central bank and the CBDC. Central banks naturally can always deliver nominal obligations. We know that central banks are the issuer of currencies. So what would a central bank run be at all? Well, a central bank run can occur in form of a run on the price level. So what we show is that if the central bank is willing to sacrifice price stability, she can always implement the socially optimal allocation in dominant strategies, and runs do not occur. But if the central bank is interested in maintaining a price stable policy while also attaining the socially optimal allocation, runs reoccur or the social optimum cannot be reached. Okay, so let me also point out that the mechanism that I've shown to you is in this model highly stylized, but also applies in a more general model where you would allow for firms and banks, etc. Okay, so thank you very much.
Thanks,
And,
Linda.
Happy
Thanks for sharing your slides. And the first question is by Refet.
So very nice delivery of a very nice paper. Thank you for that. So time-in-Dybvig is a truly wonderful framework, especially when one is thinking of a gold standard or foreign currency deposits or something of that sort, right? But an implication of that, which you also pointed out, that only an exceedingly incompetent central bank would allow a liquidity crisis in local currency in a monetary economy where it controls the supply of money. Now, so the second part of this was, well, you can still have crises if the central bank is perceived to be worrying about inflation and money, increases in money supply to control the liquidity problem will be inflationary, and the central bank is perceived to not do that. And therefore, you can still be back to the one equilibrium, so to speak. So I have two questions. One is, why is this about CBDCs and not about any monetary policy? What stops this happening from today? And the other one is, in the frameworks that we are more commonly analyzing inflation, inflation is more strongly a function of expectations and a long-run policy rule than whether there is a monetization of something today or a one-time increase in money supply because of liquidity problems. So a central bank that is able to credibly say, I will intervene and increase the money supply, increase the price level if need be, it's not exactly increase the price level, right? I will increase the supply of the numeraire, and I'm able to do so costlessly. And then I will soak this back up and not allow long-run inflation to happen. It seems to be back to this credible world where you're going to rule out the liquidity crisis, and you are not going to be in an inflation environment because you're still controlling long-run inflation expectations. Am I missing something fundamental here?
Okay, thank you very much for the question. Let me show you something that I didn't have time to show you. So your first question was why CBDC and why don't we observe this today? This is exactly, so this is something that we also believe. So the mechanism could technically already, so we believe that the mechanism is already at work. You could just have, okay, so what I've shown to you is a reduced form financial system where you only have households and a central bank. The system today is you have a central bank that purchases bonds from banks and issues reserves, and these excess reserves are lent out to firms in form of loans. And then agents can invest in the firm. They're real good, maybe labor. The firm produces over time and has output at time one and maybe higher output at time two, etc. Yeah, and so here the mechanism would work similarly if the central bank would essentially not roll over the bond from time one to time two. She's essentially pulling, and is going to cause liquidation here at the firm level, if the loan is not prolonged, etc. So you observe this already indirectly today, but the paper makes it more, I think, more direct. And in particular, CBDC is going to make it more visible that the central bank then essentially can act as an intermediary. Okay. So for your second question, inflation as a form of expectation. So the mechanism here works also through expectations. I should be more specific about it. Let me show you. Here, okay. So the run deterring policy is, okay. Here, okay, so why does the central bank implement these social optimum and dominant strategies? It's because a run deterring policy, which is already, it's set at time zero before agents make their spending decisions. Yeah. If they then in fact start spending, they anticipate the central bank to have committed to this policy. Yeah. So if there's full commitment by the central bank, then it deters the agents from spending, in fact, early, and this is going to deter the run. Yeah. So the expectation that the central bank will take care that the allocation at time 1 is low is going to deter the spending behavior indeed ex ante. Yeah. So it's the expectation that changes the behavior of the agents. Not sure whether it answered your question, but I think it goes in the direction.
Maybe we'll go for another question, Cedric.
Yeah, thank you. It's a very interesting paper. I mean, this CBDC topic is really hard to understand. So I welcome any paper that gives clarity. I had a bit of a similar concern, and Refet did an extra one. I mean, in Diamond Divig, we know that all we have to do is guarantee that the government somehow will just make us pay our deposit account. But Diamond Divig never really says where the resources are coming from. So if we have a Diamond Divig with a monetary backing of the promise to repay, it strikes me that that would be what you have. That would be my first observation. My second one, why central bankers not so keen on CBDC for many of them is a financial stability, but I don't see it as the one you have in the model. They're not afraid that people are going to run on the central bank. They're afraid that they're going to, with a click of a mouse, transfer funds from a bank to the central bank. And if so in your model, it seems to me that all the central bank would have to do is resend this fund right back into the banks and would be all done. So I think it's important to have a private bank in this and to have a mechanism why the central bank wouldn't just want to do that.
Okay, thanks so much. So coming exactly to your point of financial stability, we have a separate paper where we exactly address the issue that financial stability in the context of CBDC is more understood as runs on private banks because CBDC is perceived as safer and so on. So this is certainly also an issue with regard to CBDC, but so the runs on private banks because CBDC is offered as a competing product that is perceived as safer or more attractive for whatever reason is a topic. So here we define, as you said, financial stability differently in form of, so the run is not in the form of I run on the bank and withdraw my money because I want to deposit with the central bank. It's more that, well, I cannot buy anything with my money anymore. Okay, so this is the way we model financial stability here. You said that you can simply prevent runs on private banks through pass-through. This would work in the, so this is essentially Brunner-Meyer-Niepel paper. Right? So they have a paper on that where they say that bank runs can be prevented by central banks committing to redepositing with private banks. But this is not the notion of financial stability, again, what we address here. Yeah, so what we really mean here is, if I expect that my money cannot buy a lot of goods tomorrow, then and I anticipate that my purchasing power tomorrow will be low, then I rather spend on goods today and then I store them in my basement, essentially.
Yes, Linda, do you mind if I add something to that?
Absolutely.
So an example that we use sometimes in presentations is the price runs that you observe in Latin American economies during the 1970s and early 1980s. You know that the peso is going to devaluate in a month, or you have some expectation it may happen. People will get their pesos out from the bank and run to buy a car, food, a TV, any type of durable good. And just saying, oh, I'm taking the peso out from my bank 1 and putting it in bank 2 doesn't fix any of the problem. And this is exactly what is happening over here, because the government is going to generate inflation. Your asset, your nominal asset is going to be less valuable. Moving it from one place to the other doesn't change the fundamental problem. And that's the sense in which having 3 banks instead of 1 bank doesn't really change anything. You want to buy something real. And since everyone wants to buy something real and the supply of goods is fixed, that generates inflation.
Giancarlo?
No, just following up. I completely agree. Actually, I like the paper quite a bit. I just wonder whether, this mechanism can be there with lender of last resort, right? I mean, yes. You say the banks do not liquidate, there is a lot of money, you don't sterilize the money, there is price go up. But maybe there is more there, because there is also this strategy about liquidation. So I wonder, is there a way to because at 300-400 banks, there's also an issue of coordination there on behavior. I mean, at the limit, nobody liquidates anything, no? But you have now all these intermediate cases. Can you actually not saying why is it the same, but why is it different? What is it that can be disentangled? What opportunities not come out from the central bank?
Yes. So
decentralization.
Okay. So one thing that I think what you're aiming for is we have an extension in the paper where. So at this point, we are currently assuming that the central bank runs the entire real economy. You could imagine also to have citizens have CBDC accounts. So the central bank is going to invest or is going to stem a proportion of the real economy. And then you have a coexisting private banking system who also invest in the real economy. Then these run deterring policies are still going to work as long as private banks have the power to shorten or to pull on the liquidation technology. So think of it the following way. A private bank might by regulation be obliged to liquidate goods in a certain proportion to nominal spending. Yeah. So generically in a private banking model, you would think the private bank has to take the price level as given. And then depending on a certain nominal spending by the agent, the private bank would need to liquidate the according proportion in the real economy. Yeah. The central bank, on the other hand, can manipulate the price level. If the private banking system and the central bank coordinate in the way that if you believe that there is a centralized real goods market, if agents who spend nominal CBDC at the private bank can purchase real consumption goods that were liquidated by the central bank, and if vice versa, CBDC customers at the central bank can purchase real goods that were liquidated by the private bank, then there's a strong coordination incentive between the central bank and the private banks because otherwise large CBDC spending at the central bank can cause run on the private bank, and vice versa, large nominal spending at private banks can cause runs on the central bank. If these private banks and the central bank coordinate with regard to the liquidation policies, these runs can completely be deterred. But this kind of coordination is only possible if the private banks are not regulated to liquidate in a particular kind of way. If banks are too much, if private banks are too regulated in order to coordinate with the central bank, then we can still have run deterring policies as long as the central bank controls a sufficiently large market of the real goods technology. I think does it go in the direction, I believe.
Okay, so I think we are at the end of this session. Thanks a lot, Linda.
Thank you very much.
Nice paper. So now the session actually will be formally closed and is no longer